just give everybody a little bit of time to join us. So we will kick off at 3 o'clock. But this is very exciting. Barry's actually gone blurry for the minute, so that's how exciting he is.
I can't believe you got me back for a second time. I'm just more shocked by that.
The demand was high, Barry. We had to get you back for kind of round 2.
Yeah.
But we have lots of questions in, so I'm looking forward to picking your brains for this session.
No
trick questions, I promise.
Yeah, you said that last time, and then you did a couple of trick questions. You loaded me one from my daughter last time, which was ironic. You put it on there, and she's sitting in there.
She probably was keen to find out the response.
She was probably keen to just be annoying.
I have got a load of questions to start with, but I'm just going to give a brief introduction. So for anyone that wasn't here last time, welcome to Ask an Accountant. I'm Ashley Blue, Marketing Manager at Raffingers, and this is something we're going to be doing every other month, I believe, with various different partners at Raffingers. This week, I'm joined with Barry Soraf, who I confirmed surname is pronounced Soraf about 10 minutes before this phone call because I was nervous to say that wrong.
We've only known each other for 2 years, and you've been calling me all this time, not sure if you were getting it right.
I suddenly really second-guessed myself.
I could have been really cruel and told you you'd been getting it wrong. You know that, don't you?
But we're ready to kind of kick off this session at 3 o'clock, so I'll just give it another minute for more people to join. But as you know, this is something we're going to be doing a lot more regularly, and it just gives our followers and clients an opportunity to ask Barry any questions you might have. If there's something you're doing with regards to tax, or you've had an HMRC inquiry, or you're looking at setting up a new company and you don't know what entity to choose, whatever it might be, this is kind of your opportunity to literally pick Barry's brains with anything. So, Barry's time is expensive. So this is a really good opportunity to use this hour session with him to really just, take advantage. So let's kick off with question 1. Barry, how can I better manage my cash flow? I've got a business going, but I'm really, really terrible at managing cash flow. What can I do?
Okay, so I'm going to assume you're profitable and that it's just the cash that is a problem. Because obviously, if you're not profitable, that's probably at the root cause of any cash flow problems. But let's assume, as many businesses are, they're profitable, they're successful, but they're just not good at managing cash. The first thing to understand is to try and understand what's going wrong, and it could be any one of a number of things. So diagnosis is the first problem. It could be, for instance, that you're not collecting debtors quickly enough from payments from customers quickly enough. It could be that you're not taking all of your credit from suppliers. It could be that you're overspending in certain areas. It could be a whole range of different things. So the first part of the problem is to understand what's going wrong. Okay. Because you can't correct the problem unless you know what it is.
Yeah.
Once you've kind of done the diagnosis element, you can start to think about ways to put it right. And there's a million strategies for each problem. What I would always say is there's also some good generic disciplines, right? So good credit control is important. Yeah. I'm gonna hold back from saying maximize supplier credit, and I know this may not be a fashionable thing to say, but there are reasons often why small businesses should pay suppliers perhaps more quickly than they otherwise would. I could tell a story. I still have a very large. My son's calling me. Yeah. Okay. I'm live on Facebook, so say hello. Right. He's going to pick up my son, the other one. So there you go. I tell a story. I still do have a client. He's very, very successful, very, very large business, and he used to take enormous pride in paying all his suppliers within less than 5 days. And we're talking about large sums of money and large scale and large numbers of invoices. So it's quite a logistical achievement more than as much as cash flow achievement.
Yeah.
And his argument was always the same: is that if you look after these people, when you need their help, or when you need them to act quickly, or when maybe you're having your own problems and you need a little bit of extra help and time to pay, they'll always be there for you. So while you can, you should. That was always his motto. And and who am I to tell him he's wrong? He's very successful.
Yeah.
But within the framework of good cash flow management, you should always take reasonable amounts of credit. But as I say, sometimes there are, like I've just given you some exceptions to that rule. There are things things that don't work as well as they should if you take the maximum credit. But yeah, there's good disciplines to be had, and those are them. Making sure always. I mean, one of the disciplines you should probably get into is always having cash flow forecasts that look forward for a period of time that's as far as you can. And obviously we can help you do those if you don't do them yourself. And that's always, as I say, it's a good way of kind of seeing where the crunches are coming and kind of managing and planning for them.
Definitely. And cash flow forecast.
The generic question. If you had a specific question, I could give you a more specific answer.
No, that's really, really helpful, because I mean, obviously cash flow management is one of the biggest things that businesses are kind of trying to figure out at the moment, especially coming out of this recession. So I think having a couple of tips on how to manage cash flow and how to kind of improve cash flow is really helpful. So thank you for that. Another question is, obviously, if you're setting up a new business, how do you actually decide what business entity to choose when you're setting it up? Because I've seen recently, I know we released an article about setting up a company, for example, as an unlimited company, and then you've got limited company, you've got LLP, you've got all these different entity types. How do you choose what one is right for your business in particular?
I mean, most people make the decision based on tax, but not everyone. There are a series of other factors that you can consider, and then we'll come back to the one that you're really asking me about, which is tax. Obviously, in some businesses where risk is an issue, you would use a company or perhaps an LLP if it's a partnership and there's two of you, purely because it gives you a much better risk profile, restricting your liability to the amount of money you've invested in the business, and you can't, your personal assets are protected, and that's always a good place to be. So you don't see many, many proper businesses. I put proper in inverted commas. What I mean by that is businesses of scale and substance operating in any other way other than companies. So they're the kind of main non-tax issues that you'd consider. But when people are setting up, it's usually tax that's the driver. And it is a difficult one to answer, because obviously everyone's circumstances are different. You have to consider a wide range of factors beyond just the business. If an individual's is working in a job, you'll have a different outcome than one that isn't, even if the business is exactly the same. So it's very difficult to give generic advice. But in general, despite what I just said, if a business is very small and not earning certainly in the early days much profit, or maybe it's even losing money as it kind of builds up, customer base, whatever, you generally speaking wouldn't go to the expense of a company, because you can convert to a company later. That's particularly the case if you're going to make losses in the early years, because you can offset them against other income that you may have had if you're not a limited company, whereas you can't if you are. So the kind of the classic model when someone starts and they're very small is they'll probably be self-employed, so they won't have a company. And then at some point, as they grow, hopefully, and they're more successful, then they'll do it. Because there's a point at which it's more tax efficient to have a company, although that's changing because they've just changed. Over the next couple of years, we're seeing rises in corporation tax charges. But there's a point at which it becomes more tax efficient, but then you have to factor in you're probably going to have higher costs as well. So somewhere above the line where it becomes more tax efficient is where you would make that decision to convert. And that's where people like me earn our money, because that's the sort of question we get asked a lot. Firstly, what do we do initially, and then do we stay the same in the period thereafter? And as I say, there's no single answer to most people, because everyone's circumstances are different. But in general terms, that's how it works.
And a lot of businesses, when they are starting out, they, for example, feel like if they aren't charging VAT, then it looks like they're smaller, and they want to give the perception that they're bigger, even though they're not, right? So what would your advice be in that kind of situation?
I mean, I get it, and I've heard that argument before. And I would always support that assertion if a business was selling to customers who can recover the VAT amount. If you're selling retail or to the general public, why lose the competitive advantage that not being VAT registered has? When, to be honest with you, I doubt most customers will even notice unless they're corporate. And if they're corporate, I'd say you may as well go down. To be honest, if you're selling only to corporate customers, you'd normally VAT register anyway voluntarily, because you can make more money that way.
Yeah. That makes sense.
You can recover the VAT on your costs.
So it is ultimately, I mean, obviously, again, it seems like a generic question, but it is ultimately just depending on the type of business, who your clients are, that also has a factor to play in.
I mean, I think it's the main factor. Yeah, I think it's what, you know, if you're in an environment where your customers can't recover VAT, so it's a real, when you charge it, it's a real cost to them, and that generally means selling to the general public. If you're in that situation, then why lose the advantage of not being VAT registered? They're not going to notice, and they're not going to care. They're certainly not going to not buy from you because you're charging them less.
Yeah, definitely. And again, say you're starting out or you're in your first year or so, how do you find out your tax obligations? How do you actually know? Because I know that if I was setting up a business now, I wouldn't have a clue of what that meant tax-wise at all. So how does somebody find out what tax obligations that they might have?
Okay, well, once I went, again, we're in the danger of talking generically, but I'll try and make it as specific as I can.
Yeah.
Once you've kind of set up your structure, when you pay your taxes and how much those will roughly be is governed by the structure question you asked me before. What structure do you put in place?
Yeah.
That will define the timing and amounts of tax payments that you're going to have to make. So once you've made that decision, it becomes my job as your advisor or anyone else who's advising you to tell you certainly when. The amounts are obviously not entirely predictable at that stage, but certainly when, and sort of the broad amount, broad way in which those amounts are calculated, so you can get a feel for how much it would roughly be, and then to keep you up to date throughout that period as we go. The truth is, as I say, everyone's circumstances are different, so it's almost impossible to answer that question with sort of like really specific. But yeah, I mean, look, at the end of the day, I would say the same as I'd say to most people who are starting up their businesses. You're going to have a lot on your plate if you're successful, especially. But even if you're not, you're going to have a lot to deal with. Do you really want to be worrying about stuff that, honestly, it's taken me 30 years to get on top of? Or would you rather just ask me the question and I give you the answer? When you're starting a business, you've got a lot to worry about. The sorts of things you just asked me, how do I find out how much tax I've got to pay and when I've got to pay it? Well, that's really where you need people like me, because frankly, you're going to have so many other things that are in your skill set to deal with. So why go and learn a whole new skill set that's just going to prevent you doing the things you need to do? And there's a lot of those.
So in a way that doesn't, I don't want obviously this to sound like we're being salesy or anything, but when is the right time for somebody that's either starting a business or has a business to bring in an accountant in the first place? But when is the suggested right time to seek out an advisor with that respect? Because I know that obviously a lot of small businesses do start out thinking, that they can jump on Xero or something like that and try and manage that side of it themselves. Yeah. So when is that kind of right moment when really you should be considering seeking professional advice?
I mean, my answer to that question is, of course, I would say this, but I'll justify it, is as early as possible. And I think as early as possible means different things to different people, actually. If you've got somebody with a high degree of financial skills and, comes from a background where they've been heavily involved in running businesses and understand the vagaries and the things, the regulatory elements, the tax element, all the things that you need to know, well, then they probably don't need as much advice and probably don't need it as quickly. But if you've got somebody who's maybe been in a job their whole lives, has had no experience of running a business, knows very little about the regulatory aspects and the things that they should be doing to stay compliant and all the other stuff, well, there's no time too early. At the end of the day, most accountants, and us as included, will meet you and chat to you without charge initially. And why wouldn't you take advantage of that if you can, just to kind of make sure you've got everything you need to know?
Definitely. And again, if you're a small business and you want to claim small business tax deductions, can you claim small business tax deductions on things like charitable contributions?
I mean, to be fair, there aren't many deductions. There are a few, but there aren't many that, without getting into enormous technical detail, there aren't many deductions that apply specifically to small businesses. They tend to be universal, one or the other. I mean, yes. I mean, look, it's kind of, again, it falls in that bracket of things that really you really don't need to know a high degree of detail if you're running a business, but you need to know the sort of like you need to know the high level detail. You don't need to know the real. So if you're asking me, do charitable contributions qualify for tax relief? Well, broadly speaking, yes, but there's a lot more detail under the surface. When people ask what expenses can I deduct against my income, which I guess is what you're really asking me.
Yeah.
When people ask me that question, I always say this: look, the high amount, the detail behind that is quite complex. Yeah. What you really need to know at a high level is this: if it's genuinely a business expense, in other words, if you're spending it and in your mind you're spending it for the benefit of the business, you can probably deduct it. Again, there's some exceptions to that rule even. You can probably deduct it. And if it's not, if it, something that you've done personally and you're just trying, then you probably can't. Now, again, both of those rules are very generic and there are exceptions to both of them. And if we're clever, we can usually do things around both of those rules. But as a general high level guide to what's deductible and what's not, if you think it's a business expense, it probably is. And if you think it's not, in your heart of hearts, it probably isn't. And whilst that isn't an exact science, actually, it's much more complicated than that. That's about as good as you can get in the generic terms.
Yeah, definitely. And when it comes to tax planning, obviously we know that tax planning can massively help improve a company's bottom line, but where do you even begin to start with kind of clever tax planning? So say I came to you and I said, I've got this business, want to kind of save on tax. How do I begin with tax planning? And also, where's the line between tax planning and then dodgy tax kind of evasion?
Well, if I'm telling you to do something, it won't be over that line. That's the starting point. Right. So, I mean, that's actually a really good question. And I usually describe it, because I get asked it a lot, actually, bizarrely. I usually describe it in a set of different ways. So there are different types of tax planning.
Yeah.
There are, I often flippantly refer to these as the Tesco things, because every little helps. There are the very simple things that you just should be doing. And if we're doing our job properly, or whoever's advising you is doing your job properly, you will be doing those things, perhaps without even realizing you're doing it. Those are putting the right structure in place, making sure the income is dealt with, the way you draw your income from the business is properly managed, making sure that wherever there are obvious savings, like do you have a spouse who doesn't work, for instance, right? Obvious things that you might be able to do. Are you buying an electric car, for instance? All the things that you might be able to do to reduce your tax. We need to make sure that you're doing those things. And the way we do those things, the way we're able to do that is by understanding what's going on. So you can only really give that type of Tesco type advice, for want of a phrase, if you understand the client. So you have to spend your time speaking to them, getting to know their circumstances, both their personal and business circumstances, what other income they might have, whether they're married, do they have children, what cars they drive, do they have a pension, all of these things that can impact tax planning. It's an information gathering exercise. So you start by getting to understand those key bits of information so that you can give really obvious, for want of a better word, because I suspect it's obvious to me, but not necessarily to other people, really obvious Tesco type tax planning, the things that you should be doing just because your circumstances fit the right criteria. And then that's the job in a nutshell. And then there's the slightly more unique circumstances. So one of the things I always tell clients, and I don't understand people who don't think this way, is I'd rather they drove me mad telling me stuff that's going on that I really don't need to know than not tell me things and me miss an opportunity to help them. So there's always something that happens in most businesses. Something will happen, and that's an opportunity for us to say, if you're doing that, maybe do it a bit like this, or change that, or tweak this to make sure that you maximize the tax savings or get advantages that you wouldn't otherwise get. And again, that comes from speaking to clients. If you're not aware of what they're doing, I think the most frustrating conversation you can have as an advisor is where the client tells you 6 months later they did something and you think, oh, if only. It's really tempting to tell them to make yourself look clever, but I know that they'll punch you if you do. Is to say, oh, I wish you'd have told me that, because if you'd have told me, I could have done X, Y, and Z, and that would have saved you A, B, and C. And so that's a really frustrating place to be as an advisor. So the only way you can avoid that is to really be intimate with the client's affairs, know what they're doing, speak to them regularly, make sure that they understand and they're educated to know that if they're doing something a bit unusual or one-off or a transaction or something that's not within their normal day-to-day, that they're telling you in advance so you can give them the advice. And that's how you do tax planning. There's no great rocket science to it. You make sure, A, you're aware of all the client's basic information, you know what they're doing, you know what their life is like, and you can only do that by building relationships. And then the second part is staying on top of it so that you know what they're doing, and when you know what they're doing, you can guide them. And it's not, I mean, it sounds obvious, but there's no more to it than that.
No, definitely. I think that what you said about obviously clients just picking up the phone and letting you know what's going on so that you can spot opportunities and, whilst also helping them stay compliant with decisions that they make moving forward. It's so important that they do have that transparency with their accountancy partner and their advisor.
I mean, I've been quite lucky. I don't know if it's the fact that I've educated most of my clients along that line, or whether they just like me so much they can't help but pick the phone up or email to me. I don't know. But I do have a huge amount of correspondence and phone calls with clients every day. And a huge proportion of that is them just doing what I just told you, which is them saying, I've got this issue, I've got this thing going on. What do I do? Is there anything I need to know? Is there anything I should be doing differently? Am I doing the right things? Those are a huge, those questions and those type of scenarios are a huge proportion of my day.
Definitely. And just, this is obviously just a side note. So how does somebody know how much they should be paying themselves when they first start a business as well? Because obviously there's one thing kind of bringing in a team and kind of having clear salaries out there and comparisons of what they should be paid and knowing what you should pay them. But how do you decide what to pay yourself when you kind of get started?
It's funny, I had a meeting this morning and that question came up, bizarrely, and it did genuinely come up. So this is a new company, been trading 18 months or so, been very, very successful, and the owners are still taking almost no money out. And I just assumed in my mind that they'd chosen to take that view. But what I didn't realise until I had the meeting with them this morning is that they quite like to take more money out. They're struggling financially, personally, but they thought it was the wrong thing. I said, they thought, if they do that, they'll be hit by a great big tax bill. I said, look, let's start by making sure you're not living like paupers when you've got a very successful business earning good profit.
Yeah, sure.
Because it would be bizarre that you're working this hard, and I know how hard you work. Everyone who runs a business mostly works very hard. I know how hard you're working. I know how much effort and how much you're putting into this. If you weren't able to get some reward for that, what's the point? Ultimately, you may as well go and get a job and live a less stressful life.
Yeah.
So you need to always make sure that the risk reward is appropriate. If you can't get a proper reward out of your business for the risk and effort that you're putting into it, you have to ask yourself whether you wouldn't just be better off getting a job and living a much more comfortable, less stressful, and equally profitable life. Yeah. On the other hand, if the business is doing well, then sure, there are tax implications, but you should always make sure, look, owners should be properly rewarded. Most business owners put a huge amount of work in. They take risks. Most of the people I speak to, they don't sleep that well because they're insomniacs, but because they're always thinking about the business. I know I do it. I sit in bed at night. I suddenly think I've been laying there staring at the ceiling for 2 hours thinking about work. It's not because I'm stressed by it. It's not because I'm trying to do any, worry about what's happening today. It's just that your mind wanders into these things, and employees don't do that. That's how we are. That's how it's kind of how people who run businesses are, and otherwise they wouldn't be doing it. And you need to get a reward for that. And if you're not going to be rewarded for that effort, or in some way, whether it be financially or with the autonomy that you want and the ability to maybe work your own hours, or whatever it is that you want, it's not giving you that. Well, you have to ask yourself, why bother?
Definitely. And I think reaping the rewards of your own business is so important. There's a great book and a methodology that we are actually certified in, which is called Profit First by Mike Michalowicz. It's definitely a good recommendation to read if you are looking to switch your mindset and start taking a bit more of your profit first. And
that is Mike's, honestly, what I just said is almost Mike's kind of MO. It's like, come on, guys, you're in this, you're doing all this work, you're working really hard, and then you're telling me you can't afford to earn as much as the people who work for you. Well, you know exactly. What you're doing something wrong, and definitely. That is, I mean, I couldn't agree with that more. For the amount of hours and stress I work, there's no way on earth I'm doing that unless I'm earning well and able to do the things I want to do.
No, exactly. I think it's definitely really important if you're in business to make sure that you're getting what you wanted out of it. And always, I would say it's important to think back and look back to why you set your business up in the first place. Because if you set your business up thinking, as Barry said, that you're going to stay awake all hours of the night, but you're not earning any money or any decent living.
Can I prove categorically this is going out live by sneezing?
Yes, you can. Bless you. That normally stops someone sneezing.
I'm not actually going to sneeze now. I've managed to lose the sneeze, which is never.
That's what happens when someone says bless you early, I'm telling you.
Yeah, I know.
So, Barry, just while we're talking on kind of tax planning and paying yourself and all of that, got a question, which is, what are dividends? What is dividends, and what does that mean?
Okay, so there's we'll start with the strict legal definition of a dividend. Well, we won't actually. We'll start with a legal explanation of what a dividend is, and then we'll explain how they kind of how they're more relevant to people who run their own businesses. So a dividend is a reward to a shareholder, actually. So it's a distribution of profit made by the directors of the company to the shareholders. They once a year will sit down and say, we've made this much profit. We're going to distribute to the shareholders this amount. After we pay taxes and we've retained some to invest in the business, we're going to give this amount to shareholders as their reward for ownership. Okay, that is the essence of what a dividend is. The reason it comes up increasingly in tax planning and with people who have their own businesses is because it is still a reasonably, although less so than it perhaps was in the past, tax efficient way for owner managed businesses to draw their remuneration from out. So if you're an owner managed business, there are two phrases there, owner and managed. You are entitled to receive a salary for managing it as a director, and as the owner, you're entitled to a dividend from the profits. Now, what most people do who are OMBs, owner managed businesses, they will set the dividend and salary levels to be the most tax efficient means of distributing whatever funds they choose are appropriate to pay themselves.
Yeah.
And that's it in a nutshell.
Fine, that makes sense. We've had a question in from Peter Harris, which is, do you think the stamp duty holiday will be extended again?
Do I think or do I hope? I think it's been extended once. There's nothing to suggest it will be extended again. There's certainly no speculation. Normally they drop enough hints of this. That doesn't mean it won't be. It just means I've seen nothing to suggest it will. I think it might be nevertheless, because we didn't get a flag last time that it was going to be until the last minute, so it could be. I think that they'll come down to a judgment about what the effect is of lockdown and what have you has been on the property market. I suspect if the property market has started to improve, and there are early signs that it has, then the need for that holiday may be no longer there, and they may withdraw it, because stamp duty is a pretty good revenue raiser for the government these days, and revenue for the government's going to be everything over the next few years, I suspect.
For sure. We've had another question in from Hassan, which is, what's the most tax efficient method of buying and selling gold, silver, bullion?
I'm going to duck out of this one a little bit because this is really specialist, although I do have a client in this field. And I think what he's asking me specifically is about VAT, actually it may not be. So I'll answer it in generic terms, and then I'll give a little bit specifics, because gold, we are talking about a really specialist area. Yeah. So in terms of buying and selling anything of any description, generally speaking, if you're doing it on any sort of scale, you're probably going to want to have a company to do it, because it'll be the most tax efficient. But that's not specific to gold and silver. What is specific to gold and silver bullion is some of the VAT reliefs, and that depends on what type of gold and silver you buy, to be perfectly honest with you. I do actually have a very good friend and client who runs a company that does nothing but buy and sell gold and silver bullion on behalf of people. And if Hassan wants an introduction to them, I'm more than happy to make one.
Perfect. Hassan, if you want to, if you've got kind of any more specific advice that you're looking for, or you just want to drop us an email, we're info@raffingers.co.uk. I think our email address is actually in the comments, or you can head on the website on the team page, so raffingers.co.uk, and you can go on the team page and you'll see Barry's email on the team page, and you can get in touch with him directly if you want a specific connection. So another question we've had in, Barry, is, at what age do you recommend people start thinking about inheritance tax?
I don't know about that, but can you hear my dog barking in the background? This proof is going out live. I'm not doing it deliberately. Sneezing, dogs barking, it's great stuff. I can't even mute myself, can I? So, it wouldn't be much of an ask your accountant to be muted. So, apologies for the dog barking. She's a lunatic. She's lovely, but she's a lunatic. It's funny when you do these. I haven't forgotten the question, and I'll come to the question. But I was going to say is, whenever you do these things, there's two things that always happen. Somebody starts talking when they're muted. I haven't done that yet. And someone's dog starts barking. I have done that. So, it's good. It's good to, I don't want to let the side down. My dog always does bark on these things.
I know. It's anyway.
back to the question about inheritance tax. So you thought I'd forgotten it, but I hadn't, because it's on my little screen here as well. I've got the questions open, which says, at what age do you recommend people start thinking about inheritance tax? It's funny you mentioned that, because yet again, I had a very interesting, last Friday, I had a meeting with a client, very significant, well, reasonably significant estate. They've done very well. They've got some reasonably simple, but also some quite complex assets and liabilities in their estate. And they were asking me about inheritance tax. So we went through the estate. We talked about what assets were, they had some flexibility, where they didn't have so much flexibility. And we kind of did a kind of high level review of what they've got.
Yeah.
And then at the end of it, I said, the problem is you're still quite young, because there are a series of problems with going too early on inheritance tax. Top of that list is none of us really know how long we've got. And the problem with all inheritance tax planning is, with some exceptions, but generally speaking, the more you're willing to do to kind of mitigate your estate and reduce your inheritance tax liability, the less comfortable your life is going to be, and vice versa. So you get people at each end of the spectrum. You get some people who don't give a monkeys about inheritance tax. They say, my children are going to do very well, and they'll just have to pay the tax, and I'm not going to worry about this. It's not my problem. And you get other people at the other extreme who say, I don't care what it takes. I don't want the tax man to take a penny of my estate. I'm going to make my life as uncomfortable as possible in order to make sure they don't have to pay anything. The truth of the matter is, most people aren't either of those extremes. They're somewhere on the line between the two. They want to do something to mitigate, but they want to do it in such a way that doesn't make their life scary or uncomfortable. They don't want to leave themselves short of assets, so they can't live a comfortable life after they've worked hard in life. At the same time, if they can do things that mitigate the tax for their estate without causing too much disruption to their lifestyle, they're prepared to do that. That's where the majority of people sit. Okay. And that makes deciding on timing quite tricky, because none of us A, know how long we've got, or B, exactly what we'll need to live the life we want, or C, what the future holds, or D, what's going to happen to the values of assets and liabilities in the next 20 years or so. So it's a huge amount of what ifs in there. What happens if? And that makes timing really tricky. I guess if we're asking to answer, that's why it's a difficult question, but I guess we really should answer it. There's a general answer, which is most people start to think of it in their 50s, start to act a little bit in their 60s, and get properly proactive in their 70s, I would say. That's a generic answer. There are exceptions to that rule. Some people, you meet people who are incredibly wealthy, who want to make sure that things are in place. They're not going to run short of money over the next 20, 30 years, and they feel like they've got plenty to put aside for themselves, so they might do something younger. You've got other people who really worry about whether they're going to have enough to live on if they live a long and healthy life. And then they don't want to do much till they're very late in life, sometimes too late. The truth of the matter is, my advice to anyone is, don't do anything that makes yourself uncomfortable. Don't do anything the way you're going to have to worry about things for the rest. You want to make sure that you're comfortable, that you know that whatever happens, you're going to be able to look after yourself. You're going to be able to do the things you want to do that you've waited to do your whole life to do. So tax is an issue, but it's not the sole issue. There's lifestyle issues in there. And that's what makes it very hard for someone like me, because we have to again, it comes down to understanding the client. What is, everyone's different. What is it the client wants is fundamental to when. I've tried to answer the question, but it's actually a really hard question to answer. Inheritance tax is one of those things that's really tough. And it's also quite hard to talk about people's longevity. People don't like feeling mortal, funnily enough. None of us do. So that's a long answer to a short question, and I guess it's different for everyone. Is the short version of that.
Fine. I think that's a good answer, because essentially, if someone is starting to think about IHT or inheritance tax, they need to just get in touch with somebody to get really specialist and personal and kind of a personal approach to figuring it all out, because, as you said, each person is different and everyone has their own unique circumstances.
Correct. And then the truth of it is, you meet people who are totally obsessed by inheritance tax until they find out what's involved. The problem is, most people think that everybody else is avoiding it, and therefore they're being left behind. And the truth is, it's not as simple as that. A lot of people are doing stuff, and other people take the view they're not going to do it at all. It's just not for them. So, everyone's different. There isn't a straightforward answer to a question like that.
Yeah. And obviously this is different, but somewhat the same in terms of like planning ahead. When and how do you decide that it's the right time to start thinking about your exit plan and what that exit plan might look like?
When you start.
Oh, really?
I mean, really.
Really? So it isn't something.
I mean, it doesn't mean you have to stick to it, because it's not, you know, if you're in business 30 years, it's not going to stay the same. But yeah, I mean, it's never too early. I mean, I already know what mine is, and I'm hoping it will last the test of time. But I know what the truth is, you can't move towards something unless you kind of have an idea of the destination, can you? If you, you know, there's no. You have to ask yourself, what's the whole point of what you're doing? The whole point of what you're doing is to get out at the end. You know, is to build something that is significant and allows you to leave at the end with having achieved everything you wanted to achieve. That is almost the sole purpose. So if you haven't really got that in mind at the beginning, I'm not really sure why you did it in the first place.
Definitely. And when it comes to exit planning, is that something, like, obviously there are so many different ways of planning your exit for a business. So how do you come up with the right way that works for you? Is that something, again, that you need to kind of seek out somebody who specializes in this area, or should you just know what you're planning in terms of an exit strategy?
Again, there's almost no generic answer.
Yeah.
There are certain businesses that lend themselves to selling them, for instance, and there are others that perhaps don't. You know, and that's going to be a big factor in how you exit. There are some people who want to pass businesses down to their children because they want to create a legacy, and some don't. You get some people who have management teams who would be willing and able to take the business on going forward, and sometimes you don't. Some people just want to shut up shop at the end, take everything out and walk away from it. Everyone's got kind of a different thing in their mind, and there's no two. Firstly, there's no right answer, and secondly, there's almost no two similar answers. You get everybody's result is different depending on their circumstances. Again, I mean, you know, this is why, look, if everything was, if everything, you've asked me a lot of generic questions and I've given you a lot of generic answers, trying to make them as specific as possible. The truth is, if there were generic answers to these questions, they wouldn't need people like me. You could look it up on the internet and find the answer. The truth is, because everybody's circumstances is different, because every business is different, because everyone's got different goals and different aims and wants to achieve different things. Because of that, everyone's answer is different.
I think, to be honest, Barry, I think that's a really good place to finish this up, because it's completely true in what you're saying. There are countless questions that we've had in today, but I think all of them need kind of deep diving into the unique circumstances of where that question came from and how that question got kind of thought of in the first place. Because, you know, as you just said, there could be a business owner who's thinking about passing their business down to their daughter, right? And that person might be asking the exit planning question for their own unique circumstance. But then there could be somebody completely different who's thinking, oh, is this like a possible merger or acquisition opportunity? And how do you kind of answer those in a generic form? So I think that's a really great place
Actually, it happens in the real world. I had a client, I've still got the client actually, who I met because they wanted to sell their business. And they came to see me and they said, I want to sell my business. How do I go about doing it? And this was a few years ago. And I said, well, tell me a bit about what your thinking is. And what I realized worked out very quickly was he didn't actually want to sell it. He just wanted some money. He wanted to have a big chunk of money out from the business and kind of have a less stressful life, but he still actually wanted to be involved. And in reality, he didn't know how he was going to go selling it because he didn't have anyone to sell it to. So we sat down and we talked this through, and through the long discussion we had, it came clear that he had 2 or 3 people working for him who were willing and able to take it over and leave him with a kind of share in it, and, you know, and pay him going forward and pay him some money out initially. And it kind of ticked all the boxes. So that's what we did, you know, and that's what we've done. And that's what the business is now. He's got new owners, very successful. He's still involved. They're paying him. He's very happy. He's semi-retired. He's still involved in the business. So he does the bits he still enjoys. He's got some money. They're very happy because the people who work for him now feel a little bit more autonomy, and they've got a little bit of, they're earning a bit more money and they're enjoying it, and, you know, and they're taking the business in a slightly different direction. Blah 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 blah. Everyone wins, you know.
Yeah, exactly. I think it's definitely an interesting one, isn't it? Because I think it's worth holding these sessions because it gives people the opportunity to ask you questions. For example, you know, about buying and selling gold, silver, bullion. But
I didn't see that one coming. But, you know, it's why we know it's live. Me sneezing, dogs barking, and questions I'm not prepared for.
Exactly. So I think I think it's really worth doing the sessions for that reason. But at the same time, I would say that for anybody listening who really, really wants to kind of get to the root of the questions that you've asked, or just wants to find out more about a specific topic, maybe it's tax planning, maybe it's, I don't know, mergers and acquisitions, or whatever it might be, just get in touch with Barry or myself, or just info@raffingers.co.uk, and we'll be here to help. Thanks, Barry.
Yeah, I agree with that. Thank you.